All right, we got the jobless claims numbers in 227,000 versus consensus of 238,000. Joining us to talk about the economy and the inflation and much more, Lael Brainard, who served as former National Economic Council chief in the Biden administration and a former Fed vice chair, now a distinguished fellow at Georgetown and a senior fellow at Harvard's Kennedy School. First off, what does the employment picture in the nation tell you about where we are in the economy and what's next for the Fed, Lael?
Yeah, well, good morning. So the jobless claims today, I think, were reassuring. They bump around a lot in the summer months, so it wouldn't take too much signal from any week of numbers. But if you look at the payrolls numbers that we just got, the labor market still seems to be balanced. It is certainly softer than it was this time last year, but it is in good balance. And that means that with that and the inflation numbers, which have also been pretty benign, it does give the Federal Reserve a little bit of room to contemplate continuing to cut rates later in the year.
We've seen that the odds for a September rate cut have been lowered, but you still have a couple Fed governors Waller and Michelle Bowman indicating that they think there could be cuts as soon as this month. Where do you stand on whether rate cuts should come down the pike?
Yeah, so the way that I think the minutes showed yesterday, a majority of people on the committee that sets monetary policy think that they still need to wait a little bit, that there's a real potential for inflation to go up because of the tariff increases that are not finalized in the pipeline, but they're getting more comfortable with the idea that there are going to be cuts later in the year, probably starting perhaps in September. You're right that two members of the board have said they're open to a July cut. It's not coincidental, perhaps, that they are both people who have been appointed by President Trump and perhaps share the views of the White House to a greater degree. But if you look at the overall minutes, it does suggest they're contemplating lowering rates later in the fall.
You have an op-ed just recently in the Washington Post about this tiff between President Trump and Jerome Powell and why you think the president wants to remove Jay Powell from his leadership role at the Fed. Talk us through your points about this a bit.
Yeah, so I was really surprised to hear the president say that the Federal Reserve Chair should be cutting rates because it will save this administration money on the interest payments they need to make on this $4 trillion increase in the national debt from the mega law that was just passed. And so he's very direct about it. As you know, he sent a handwritten note to the chair of the Fed making this point and said in a public event that for every percentage point that Jerome Powell lowers rates, that would amount to $300 billion worth of saved interest payments. Now, as you said, you know, I was on the Federal Reserve Board for 9 years, including as vice chair. We did not take into account Treasury debt management. That's not the role of the Federal Reserve. Congress tells it to focus on fighting inflation and also maintaining a good labor market. And so there's a real concern that if the Federal Reserve Chair that is appointed by this president believes their job is to focus on long-term Treasury rates, that they will lose credibility in terms of their fight against inflation. That actually will cost us more in terms of long-term Treasury interest payments over the next several years.